Dan Ives, global head of technology research at Wedbush Securities, recently joined CNBC International and made a bold prediction. He believes we're only about 10% through the AI revolution and compares today's AI boom to 1996, not the 1999 dot-com bubble. According to Ives, companies will continue spending heavily on AI for years because standing on the sidelines simply isn't an option in this technology race. In this video, I'll first show you the clip of Dan Ives' interview, then I'll break down exactly what he said, share my own reaction and analysis, and reveal two of the best AI stocks to buy and hold for the long term. Let's hear what Dan Ives has to say.
Look, I mean, obviously these are sort of the tug of war, but when you look at all the numbers that we're seeing, the forward indicators, Dell, you look at the data layer in terms of what we see with Snowflake and others, I mean, we're still less than, call it 10, 15% through this. So companies, they're going to continue to spend for the next few years. Costs will go down, but they cannot just sit there and watch us from the stands. And that's why the markets are telling you, this is still just the early part of this AI revolution.
Dan, then circling back to the comments that you're making about the value moving from the AI frontier models, we've not seen that overnight. The pre-IPO valuation of Anthropic, $965 billion, suggesting that, in fact, the valuation appetite is still there. Why do you think, though, we should, as investors, be thinking not just about the frontier layer, but moving further down into some of the application areas?
Yeah, look, Anthropic, they're the golden child in terms of this AI revolution. OpenAI clearly is going to be in this two-horse race, but we've never seen unprecedented growth like this. But it shows what you're seeing from Anthropic. That's just the tip of the sphere. You have to also play the second, third, fourth derivatives. And what we've seen from the data layer, if you look from Palantir to Datadog to Innodata, look at the Snowflake numbers, and now look on the server side what you're seeing with Dell. It's spreading in terms of the AI monetization, and that's bullish for the market. Continues to be our view. Like, look, this AI party, it started at 9 p.m. It's about 11:30 p.m. That party goes to 4 a.m., and I think that's why we're still early days.
Dan, how are you thinking about the free cash flows? Because even when it comes to the semiconductor layer, it's really hard to ascertain what is decent value at this point, because on many metrics, a lot of these stocks look overvalued. But if the free cash flow changes because of this AI adoption story that nobody can get a handle on or nobody can predict, then what does it mean in terms of valuation for the sector?
Yeah, look, it's a great question. When we look out over the next, you got to look out 12, 18 months. On the other side is when CapEx ultimately starts to moderate a bit, monetization free cash flow then starts to ramp. Once that crisscrosses, I mean, that's how investors are viewing this. It's not necessarily on numbers this year, and it's looking out the next 2, 3, 4 years. And I think free cash flow, you're going to have a boom of free cash flow, not just from Mag 7, from broader tech, as you see the monetization. That's how investors are looking at valuations here. You got to view this as just the first start of what's going to be $4 trillion spent in AI. And we continue to view that, a lot of talk about bubble, and this is a 1996, 1997 moment, not a 1999, 2000 bubble moment.
Oh, wait, hang on, Dan. Does that mean that in 2 years we approach the 1999 moment?
And that's the good thing about this. That's why I had to get the popcorn out, because it's not. Because tech stocks are trading 27 times earnings. We're going to be talking about physical AI when it talks of robotics, autonomous. You think about what's happening in space. It's a true fourth industrial revolution. I don't view at the end of this, at that 4 a.m., that there's that sort of moment. And I think you're going to have winners and losers, but it's our view. That's how we look in NASDAQ 30,000, and it's our view, the second, third, fourth derivative, just like we saw this week, Snowflake, we see with Dell, that's showing where the spending is.
Dan, I know you've got a call on some of the cybersecurity names from Palo Alto Networks to CrowdStrike, and I want to talk about how the disruption could impact some of these. I can see that Palo Alto apparently used Mythos as we talk about the technology from Anthropic. It feels like it could be disruptive, but they've been using it to find vulnerabilities in their own system. Apparently found 75 vulnerabilities in their own products in 1 month versus typically 5 to 10. Do you see this disruptive tech as supportive, helpful for their revenue, or potential disruptor down the track?
Look, I mean, cybersecurity, and look, this is part of the AI ghost trade. If you go back, call it in March, but we strongly disagree with it because the surface area is increasing. For every person, if there's 4, 5, 7 agents, that's just more demand for cybersecurity. CrowdStrike, Palo Alto, kind of front and center as the two leaders, and I think we believe from everything budgets could go from 5% to 10% in terms of over the next few years in terms of cybersecurity, and it's a good example of like the derivative beneficiaries, and you cannot get caught up sometimes in negative narratives. I mean, go back a year ago, Alphabet. I mean, the London cab driver was bearish on Alphabet. Now today, look at it. So it's very easy to get caught up in narratives, and I just think that creates the opportunities if you're able to see around corners in terms of this AI revolution.
Dan, can I ask you about some of the big listings coming up? Because initially it felt like OpenAI was going to be the big blockbuster one for this year, maybe SpaceX by numbers. Now Anthropic, the pre-market, the pre-IPO valuation is enormous. What's the most interesting one to you?
Look, I mean, we're talking about what's going to be a historical period in the history of Wall Street, right? When it goes to SpaceX, Anthropic, and OpenAI, I mean, really three sort of pillars of fourth industrial revolution. Look, right now, in terms of Anthropic, I mean, it's the best model in the world, and I don't think really there's a dispute there. That'll put more pressure on Alma and OpenAI, which I view as just really central, foundational to AI revolution. That's why investors, they've seen it in the private markets now in the public markets, and this is going to be extremely positive for just broader AI, these companies being public, because they are core to the rest of tech in terms of how it all plays out.
What Dan Ives laid out in this interview was essentially a bullish roadmap for where he believes artificial intelligence investing is headed over the next several years. His core message was simple. Despite all the excitement, massive stock gains, and eye-popping valuations we have already seen, he believes the AI revolution is still in its early innings. Right from the start, Dan points to what he sees as the most important evidence supporting his view. He looks at companies like Dell, Snowflake, and other firms operating across the AI ecosystem and concludes that businesses are nowhere near finished with their AI spending cycle. According to him, we are only about 10% to 15% through this transformation. That is a remarkable statement when you really think about it. Most investors today look at the incredible gains in AI-related stocks and assume the easy money has already been made. Dan is arguing the exact opposite. His view is that companies have no choice but to continue investing because sitting on the sidelines is simply not an option. If your competitors are using AI to improve productivity, reduce costs, develop products faster, and better serve customers, then refusing to invest becomes a strategic disadvantage. Personally, I think this is one of the strongest arguments in favor of AI spending continuing for years. Throughout history, when a transformative technology emerges, companies rarely stop investing because they are worried about short-term costs. Instead, they invest because they are afraid of being left behind. We saw it with computers, the internet, smartphones, cloud computing, and now AI. One of the most interesting parts of the interview was when Dan discussed how investors should think beyond the frontier AI companies themselves. Everyone talks about OpenAI and Anthropic. These companies dominate headlines because they are creating the models that power much of the AI revolution. Anthropic's massive valuation is proof that investors continue to place enormous value on these leading AI developers. But Dan argues that investors should not stop there. He describes Anthropic and OpenAI as the tip of the spear. In other words, they may be leading the charge, but there are many other companies positioned to benefit from the expansion of AI. He highlights businesses operating in what he calls the second, third, and fourth derivatives of AI. These include data infrastructure companies like Snowflake, analytics platforms like Datadog, government and enterprise software players like Palantir, and hardware providers like Dell. This is an important distinction. Many investors become obsessed with finding the next OpenAI. However, some of the biggest winners of technological revolutions are often the companies providing the tools, infrastructure, and services that make the revolution possible. Think back to the internet boom. While many internet startups disappeared, companies supplying critical infrastructure often emerged as long-term winners. Dan believes AI could follow a similar path. One of his most memorable analogies was when he compared the AI boom to a party. He said the AI party started around 9 p.m., and now it is only around 11 or 11:30 p.m. The party does not end until 4 a.m. What he is really saying is that investors are still relatively early in the cycle. The excitement has started, but the largest opportunities may still be ahead. Of course, one question investors constantly ask is whether these stocks have become too expensive. After all, many AI-related companies are trading at valuation levels that would normally make investors nervous. Dan addresses this concern by focusing on future free cash flow. His argument is that investors cannot evaluate AI companies based solely on today's earnings or today's cash flows. Instead, they need to look 12, 18, 24, and even 36 months into the future. Right now, companies are spending heavily on infrastructure, data centers, chips, and software development. These investments naturally suppress free cash flow in the short term. However, Dan believes a turning point is coming. As capital expenditures begin to moderate and monetization accelerates, free cash flow could surge across the technology sector. In his view, investors are not buying what these businesses earn today. They are buying what these businesses could earn several years from now. Whether you agree or disagree, this is a critical concept because it explains why many AI stocks continue to command premium valuations despite appearing expensive on traditional metrics. Another major point Dan makes is his comparison between today's AI boom and the dot-com era. Critics frequently argue that AI resembles the technology bubble of 1999 and 2000. Dan strongly disagrees. Instead, he compares today's environment to 1996 or 1997. That distinction matters because 1996 and 1997 represented the early stages of internet adoption. The technology was real, growth was accelerating, and many of the biggest gains were still ahead. By contrast, 1999 and 2000 represented the peak of speculative excess. Dan's argument is that we are not yet in the speculative mania phase because AI adoption is still accelerating and real business value is still being created. Personally, I think investors should appreciate both sides of this debate. Dan may be right that AI adoption remains in its early stages. However, history also teaches us that transformative technologies can still experience periods of excessive speculation along the way. The technology can be revolutionary while certain stocks still become overvalued. Those two things are not mutually exclusive. Another fascinating part of the discussion involved Snowflake. Dan repeatedly returns to Snowflake because he believes the company's recent performance provides evidence that AI monetization is expanding beyond the model creators. For a long time, investors worried that AI would destroy traditional software businesses. The fear was that advanced AI systems would make many existing software products obsolete. Dan believes Snowflake's results challenge that narrative. Instead of being disrupted, companies operating in the data layer are finding new opportunities because AI systems need data to function effectively. This is something many investors overlook. AI models are only as useful as the data feeding them. Organizations still need ways to store, organize, manage, secure, and analyze massive amounts of information. That creates opportunities for companies specializing in data infrastructure. One area where Dan remains particularly optimistic is cybersecurity. Some investors worry that AI could disrupt cybersecurity firms. Dan sees the opposite happening. His argument is straightforward. As AI adoption increases, organizations will deploy more AI agents, more connected systems, and more automated workflows. Every new connection creates additional security risks. As the digital attack surface expands, demand for cybersecurity solutions should increase as well. That is why he highlights companies like CrowdStrike and Palo Alto Networks as potential beneficiaries of the AI boom. I actually find this argument very compelling. Whenever technology creates new opportunities, it also creates new vulnerabilities. Cybercriminals adopt new technologies just as quickly as legitimate businesses do. As AI capabilities improve, cybersecurity may become even more important rather than less important. The interview also addressed concerns about whether businesses are actually getting enough value from AI to justify current spending levels. Some corporate leaders have begun questioning whether their AI investments are delivering sufficient returns. This is one of the biggest risks facing the AI investment story. Eventually, companies must demonstrate measurable benefits. Dan acknowledges that some businesses may slow spending at certain points. However, based on his conversations with executives, chief information officers, and technology decision-makers, he says spending trends remain strong and continue to accelerate. His view is that enterprises are still in the early stages of discovering AI use cases, and that realization is fueling further investment rather than reducing it. This is where I think investors need to pay close attention over the next couple of years. The AI narrative has largely been driven by expectations. At some point, expectations must be validated by productivity gains, revenue growth, cost savings, and profit expansion. The companies that successfully prove those outcomes could become major winners. The companies that fail to do so may struggle regardless of how exciting their AI stories sound. Toward the end of the interview, Dan makes another important observation about AI itself. When asked whether artificial intelligence is truly intelligent, he essentially argues that today's model should not be judged solely by today's capabilities. His point is that the worst AI model people will ever use is the one available today because tomorrow's version will likely be better. That statement captures the rapid pace of AI development. Every month, models become more capable, more efficient, and more useful. Dan believes this constant improvement cycle will eventually unlock applications that seem difficult or impossible today. That perspective also helps explain why so many companies continue investing aggressively despite concerns about current limitations. Finally, Dan discusses what could become some of the most important investment opportunities of the next decade. He highlights 3 companies that he views as foundational pillars of the fourth industrial revolution: OpenAI, Anthropic, and SpaceX. These companies represent different aspects of technological transformation, but all 3 occupy central positions in major innovation trends. Dan believes public market investors are witnessing a historic period similar to the early stages of previous technological revolutions. Whether or not his most bullish forecasts ultimately come true, his overarching message remains consistent throughout the interview. He sees AI not as a short-term trend, but as a multi-year transformation that will impact nearly every sector of the economy. His thesis is that investors who focus only on the headline names may miss many of the biggest opportunities. The real winners could emerge across data infrastructure, software, cybersecurity, hardware, and countless other areas that support the broader AI ecosystem. My biggest takeaway from this interview is that Dan Ives is not simply betting on AI models. He is betting on an entire economic transformation. He believes we are still much closer to the beginning than the end, and that the companies enabling AI adoption across industries may ultimately become just as important as the AI creators themselves. Whether you agree with his bullish outlook or remain skeptical, one thing is clear: the AI investment story is evolving rapidly, and understanding where the money is flowing beyond the headline companies could be one of the most important factors for investors in the years ahead. Now let's dive in and reveal 2 of the best AI stocks you can buy and hold forever. These are businesses with enormous scale, powerful competitive advantages, and the financial firepower to shape the future of AI itself. The first AI stock on the list is Meta Platforms, ticker symbol META. Now I know some investors may be surprised to see Meta at the top of this list. When most people think about artificial intelligence, they immediately think about chatbots, chips, data centers, and software companies. They don't necessarily think about Facebook, Instagram, WhatsApp, or Threads. That is exactly why I believe many investors are underestimating Meta's long-term AI opportunity. Before we even talk about financial results, let's talk about why this business matters. Meta controls some of the most valuable digital real estate on the planet. Every day, billions of people use its platforms to communicate, consume content, share information, watch videos, and interact with businesses. Few companies in history have achieved this level of global reach. The real advantage here is not simply the number of users, the advantage is data. Artificial intelligence becomes more valuable when it has access to larger amounts of data, stronger user engagement, and more opportunities to learn from human behavior. Meta has all 3. Every interaction on Facebook, Instagram, WhatsApp, and Threads generates valuable signals that help improve recommendations, advertising performance, content delivery, and AI products. This creates a powerful competitive advantage that is extremely difficult for competitors to replicate. And management is not sitting still. Meta is aggressively investing in AI infrastructure because it understands something many investors still do not fully appreciate. The future of technology will not be determined solely by who has the best AI model. It will be determined by who can deploy AI at scale to billions of users. That is where Meta has a tremendous advantage. In recent quarters, Meta has been integrating AI throughout its ecosystem. AI is helping improve content recommendations. AI is improving ad targeting. AI is helping businesses communicate with customers. AI is helping creators reach audiences more efficiently. And these improvements are already showing up in the numbers. Meta's first quarter revenue surged 33% year over year to more than $56 billion. That is an extraordinary growth rate for a company of this size. Most businesses would be thrilled to grow at half that pace. Even more impressive is where that growth is coming from. The company's advertising engine continues to become more effective because AI is helping advertisers generate better results. ad impressions increased significantly while average pricing also moved higher. That combination is extremely powerful. When a company can increase both the volume of ads served and the amount advertisers are willing to pay, revenue growth can accelerate very quickly. This is exactly why Meta remains one of the strongest cash-generating businesses in the world. Yet despite those impressive results, many investors remain skeptical. Why? Because Meta is spending enormous amounts of money on AI infrastructure. The company has projected capital expenditures that could reach between $125 billion and $145 billion this year as it builds data centers, purchases advanced computing hardware, and develops next-generation AI capabilities. Those numbers are massive. In fact, the spending plans are so large that they have scared some investors away from the stock. But here's the question investors should be asking. What happens if Meta is right? Think about it. If artificial intelligence becomes as transformational as many industry leaders believe, then the companies that build the infrastructure first could end up capturing enormous rewards later. Meta's management clearly believes the bigger risk is not overspending. The bigger risk is falling behind. Personally, I think this is one of the most important investment debates happening in the market today. Many investors are focused on the short-term impact of higher spending, but long-term investors should be focused on what that spending is building. If these investments create the next generation of AI products, digital assistants, smart glasses, creator tools, advertising systems, and enterprise solutions, then today's spending may look incredibly smart in hindsight. Another reason I remain bullish on Meta is because investors often overlook how cheap the stock appears relative to its growth. At one point this year, Meta traded more than 20% below its all-time high even while delivering some of the fastest revenue growth among large technology companies. Even more surprising, the stock has traded at a forward earnings multiple below the broader market despite generating significantly faster growth. That creates a very unusual situation. Normally, investors pay premium valuations for premium growth. With Meta, investors have often been able to buy both growth and value at the same time. Those opportunities do not come around very often. Now let's talk about what could become Meta's next major growth engine. Most investors still view Meta primarily as an advertising company, and to be fair, advertising remains the overwhelming majority of revenue today. But management is actively creating new revenue streams that could become meaningful contributors over time. One of the most interesting developments is Meta's move into subscription services. The company recently introduced premium subscription offerings across its platforms while also testing higher-tier AI-focused subscriptions designed for power users and businesses. These offerings range from affordable consumer plans to premium AI subscriptions that unlock more advanced capabilities. This may not sound like a huge deal initially, but think about the scale involved. Meta has billions of users. Even if only a small percentage decide to pay for premium AI features, advanced tools, or enhanced platform experiences, the revenue potential becomes enormous. This creates something investors love: recurring revenue. Advertising revenue can fluctuate with economic conditions. Subscription revenue tends to be more predictable and stable. The combination of advertising, subscriptions, AI services, and potentially other future monetization opportunities gives Meta multiple paths to grow over the coming decade. And there is another long-term opportunity that investors are just beginning to discuss. Meta's AI infrastructure investments have become so large that management has even suggested that offering cloud computing services could eventually be a possibility. Imagine that for a moment. A company already generating tens of billions in advertising revenue could potentially leverage its massive AI infrastructure to create entirely new business lines. That optionality is difficult to quantify today, but optionality often creates some of the biggest winners in the stock market. What excites me most about Meta is that investors are not paying solely for future possibilities. The core business is already producing exceptional results. The social media ecosystem remains dominant. Advertising continues to grow. AI is already improving business performance, and new opportunities are emerging on top of that foundation. In other words, investors are not betting on a company that hopes AI will save its business. They are investing in a company that already has a highly profitable business and is using that cash flow to build the future. That is a very different investment proposition. When I look at Meta, I see a company with billions of users, powerful network effects, world-class AI talent, enormous cash generation, and multiple long-term growth drivers. Could the stock experience volatility? Absolutely. Could investors continue to worry about spending levels? Of course. But if your goal is to own a business for the next 10 years rather than the next 10 weeks, Meta Platforms looks like one of the strongest AI investments available today. And that's why Meta Platforms, ticker symbol META, earns the first spot on this list of the best AI stocks to buy and hold forever. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second AI stock to buy and hold forever is Broadcom, ticker symbol AVGO. If Meta represents the consumer-facing layer of AI, Broadcom represents the hidden backbone that makes everything possible. And this is where a lot of investors underestimate the real AI opportunity, because the biggest winners in technological revolutions are not always the most visible companies. They are often the ones building the infrastructure that everyone else depends on. Before we even talk about numbers, you need to understand what Broadcom actually does in the AI world. Broadcom is deeply embedded in the semiconductor and infrastructure ecosystem. It designs and supplies critical components that power networking, data transfer, and large-scale computing systems. In simple terms, if artificial intelligence is a high-speed highway, Broadcom is building the roads, tunnels, and traffic systems that keep everything moving without crashing. As AI models become more powerful, they require exponentially more data movement between chips, servers, and entire data centers. This is where Broadcom becomes essential. One of the most important shifts happening right now is the move toward custom AI chips and high-performance networking solutions. Companies are no longer just buying off-the-shelf processors. They are designing entire systems optimized for their specific AI workloads. Broadcom is one of the key partners enabling that transition. It helps hyperscale customers design custom silicon solutions and provides networking technology that allows massive AI data centers to communicate efficiently at scale. Without that infrastructure, AI systems would quickly hit bottlenecks, and bottlenecks are the enemy of progress in artificial intelligence. Now let's talk about why this matters from an investment perspective. AI is not just a software revolution, it is a physical infrastructure revolution. Every improvement in AI capability requires more compute power, more data movement, more energy efficiency, and more advanced chip architecture. This means demand for semiconductor and networking solutions does not just grow linearly, it compounds. Broadcom has positioned itself at the center of this compounding demand curve. One of the most important aspects of Broadcom's business is its exposure to custom AI accelerator chips and networking components used in large-scale data centers. As companies like hyperscalers continue to expand AI infrastructure, they increasingly rely on Broadcom's technology to optimize performance and reduce latency. This creates a powerful long-term tailwind. Now let's talk about financial strength, because this is where Broadcom really stands out. Unlike many companies that are still investing heavily without clear profitability, Broadcom is already a cash-generating machine. The company has consistently delivered strong revenue growth driven by demand across AI infrastructure, networking, and semiconductor solutions. More importantly, Broadcom is known for its disciplined capital allocation strategy. It focuses on high-margin businesses and long-term contracts with major customers, which creates predictable revenue streams. This predictability is extremely valuable in a sector that is otherwise cyclical and volatile. Investors are not just buying growth with Broadcom, they are buying durable cash flow. And in the AI era, that combination becomes even more powerful. As AI infrastructure spending continues to expand, Broadcom is positioned to benefit from multiple layers of demand. First, increased data center construction drives demand for networking chips. Second, more advanced AI models require higher bandwidth and faster communication between systems. Third, custom chip design partnerships expand Broadcom's role deeper into hyperscale ecosystems. All three forces work in the same direction. They reinforce each other. That is what makes Broadcom so compelling as a long-term AI compounder. Now let's address valuation, because this is where investor psychology often becomes difficult. When a stock performs well and is tied to a major trend like AI, investors naturally worry about whether it has already become too expensive. But with Broadcom, the real question is not whether the stock looks expensive today. The question is whether the company can continue compounding earnings over the next decade as AI infrastructure spending accelerates. If AI data centers continue to expand globally, Broadcom is not a one-cycle beneficiary, it is a multi-cycle infrastructure provider. That is a very different investment profile. We are not talking about a company that benefits from a single product cycle. We are talking about a company that sits at the center of global compute expansion, and that brings us to one of the most important themes in this entire AI revolution: durability. The companies that win long-term are not necessarily the ones with the flashiest products. They are the ones that remain essential regardless of which AI model wins or which software platform dominates. Broadcom falls directly into that category. It does not matter whether the future is dominated by one AI model or 10 competing models. All of them require infrastructure. All of them require networking. All of them require semiconductors that can move data efficiently at scale. This is why Broadcom is often considered one of the most important behind-the-scenes beneficiaries of artificial intelligence. And there is another angle investors should not ignore. As AI workloads grow, energy efficiency and chip optimization become critical. It is not just about raw computing power anymore. It is about maximizing performance per watt and reducing latency across massive distributed systems. Broadcom's engineering expertise positions it well in this environment. Now, stepping back, this is what makes Broadcom so interesting in the context of the broader AI ecosystem. Meta builds the consumer layer, Broadcom builds the infrastructure layer, and both are benefiting from the same underlying trend: the global acceleration of artificial intelligence adoption. When you connect these dots, you start to see why investors like Dan Ives describe this as still being early innings. Because the ecosystem is still expanding in every direction: new applications, new infrastructure, new compute demands, new monetization models. And companies like Broadcom sit directly in the middle of that expansion. There is also a broader strategic implication here that many investors miss. As AI becomes more important globally, control over semiconductor and networking infrastructure becomes a geopolitical advantage. This is not just about earnings, it is about technological leadership at a global scale. And companies embedded in that infrastructure layer tend to benefit from long-term structural demand. That is the kind of positioning investors look for when they want businesses that can potentially compound for decades. Now, before we move on to the final stock in this list, it is important to understand the key takeaway from Broadcom. You are not investing in hype. You are investing in infrastructure. You are investing in the physical backbone that makes artificial intelligence possible at scale. And that is why Broadcom, ticker symbol AVGO, remains one of the most important AI stocks to buy and hold for the long term. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, when we step back and look at the two companies in this video, a clear structure begins to emerge. Meta operates at the application and consumer engagement layer, and Broadcom operates at the networking and semiconductor infrastructure layer. Together, they represent two different but interconnected layers of the same AI revolution. That is what makes this opportunity so powerful. You are not betting on one trend, you are investing in an entire ecosystem. Before we finish, there is something important to keep in mind. The AI revolution is still evolving. New winners will emerge. New technologies will develop, and competition will continue to intensify. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now let me ask you something. When you look at Meta and Broadcom, which do you think has the strongest long-term advantage in the AI revolution and why? Because this is not just about picking stocks, it is about understanding where the real power in this new technological era will ultimately concentrate. And that is the question every serious investor should be thinking about. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.